At some point, you start noticing something. The people who feel the most squeezed by tax aren't always the one making the least. They're usually doing everything right. Good income, hard work, nothing obviously reckless. And yet every year feels the same. More effort, more pressure, same result. That's when the question changed from, why are my taxes so high, to what am I missing? Most people think taxes are about deductions. They're not. They're decided before deductions ever show up, by how income shows up on your tax return. If this is wrong, every strategy after this is capped. Here's what we're going to do next. I'm going to show you why how income shows up matters more than deductions or write-offs. Then I'm going to walk through a clean comparison that shows how the same business can produce very different tax outcome. This is move number one. Everything else builds on this. Here's the rule that almost no one explains clearly. The IRS taxes income differently based on what type of income it is. Not effort, not intelligence, not sacrifice. Just the bucket that the dollar falls into. And the most expensive bucket in America is earned income. When income shows up as earned income, three things happen immediately. Ordinary income tax applies, payroll or self-employment tax apply, flexibility disappears. No timing, no sequence, no leverage. The system takes its cut before you get a say. That's why people with solid income still feel squeezed. The dollar arrives already damaged. Business income doesn't avoid taxes. That's not the advantage. The advantage is control. With the right structure, you decide how much is wage, how much is not, how exposed each dollar is. Same money, different behavior, that's the shift. Let's put numbers on it. The business generated $120,000 of profit. In scenario A, there is no structure by default. This includes sole proprietors, single member LLCs, taxes, disregarded entities, and Schedule C income. In this setup, all $120,000 is self-employment income. The full 15.3% self-employment layers apply, plus ordinary income tax. That payroll layer alone is about $18,360. No separation, no control, no choice. In scenario B, we have a business that elects S-Corp status. You pay yourself a reasonable salary of $60,000 that's supported. Payroll tax applies only to that $60,000. The remaining $60,000 flow out as distribution. That income is still taxable, but it's not subject to self-employment tax. That's one decision that removes the 15.3% layer from half of the profit. That's about $9,180 saved. Same business, same profit, different structure. This is the first real tax lever. Now let's extend that same logic. In 2025, the Social Security wage base is $176,000. That means that the Social Security portion caps there. Medicare does not cap. It keeps going beyond that amount. Now here's the important part. Distributions from an S-Corp do not pay self-employment tax. So using the same reasonable salary example, $60,000 wages. If the business earns $176,000, the remaining $116,000 flows out as distribution. That $116,000 avoid the full 15.3% layer that would have applied if it was classified as self-employment income. That's $17,700 not paid before income tax is even considered. That's your savings. Above the Social Security cap, the extra saving is mainly the Medicare layer. But the point stays the same. This move gets more valuable the more profit you have above your reasonable wage. A quick note. The S election, the structure is elected by filing a Form 2553. The business files a tax form 1120S. The income flows through a K1 and lands on your 1040. I'll walk through the mechanics step by step in a separate video. This one is about why it matters. This works when reasonable comp is real, payroll is real, filings are clean, structures matter more than aggression. This is where you realize I wasn't bad at taxes, I just never chose how my income showed up. And that's exactly why you're overpaying in your taxes. In the next video, we're going to talk about move 2. We're not going to talk about random write-offs. We're going to talk about creating a clean deduction on purpose once income is flowing correctly. We're going to be covering 3 things: paying your kid through the business, done correctly with real work and real payroll, why that pay is a real business expense, meaning it is deductible to the business and income to the kid, as well as the paper trail that keeps everything conservative, the job description, time, pay rate, payroll records. That's going to be in the next video, move 2.